Why should we care about the Federal Reserve's interest rate decision? What does it mean for the economy, and more importantly, how does it affect you? To begin with, the Federal Reserve, or the Fed, is the central bank of the United States. Its actions have a profound influence on the economy, shaping market dynamics and impacting economic growth. Recently, the Fed made a decision on interest rates that has been under the microscope by investors, economists, and policymakers alike. So what are the key takeaways from this decision? Firstly, the Federal Open Market Committee, or FOMC, released its dot plot projections, which revealed that the median official expects 3 quarter-point rate cuts in 2024. This aligns with the previous round of quarterly forecasts in December. Interestingly, the median forecast for 2025 has risen to 3.9% from 3.6%, indicating a more hawkish stance for the longer term. Secondly, the FOMC unanimously voted to leave the benchmark rate unchanged within the target range of 5.25 to 5.5%. This level of rate represents a 2-decade high. The committee has made it clear that it does not anticipate rate cuts until it gains greater confidence that inflation is sustainably moving toward the 2% target. On the matter of inflation and economic growth forecasts, the median forecast for personal consumption expenditures inflation remains steady at 2.4% for 2024. However, the projection for core PCE inflation has risen slightly to 2.6%. The economic growth estimate for 2024 has seen a considerable jump to 2.1% from the previous 1.4%. The Fed officials have also tweaked their long-term rate estimates, with the median now at 2.6%, up from 2.5%. This implies that rates may need to stay higher for a longer duration in the future. Lastly, the Fed continues its pace of quantitative tightening, with a maximum of $60 billion of treasuries and $35 billion of mortgage-backed securities rolling off the balance sheet each month. Policymakers did not provide any immediate hints of changes to this program, despite scheduled in-depth discussions during the meeting. Now, how does this decision impact the market and economy? In the equity markets, the dot plot projections and the Fed's commitment to maintaining rates at current levels may provide stability. However, investors will be keenly observing any shifts in the long-term rate estimates, as they can impact stock valuations and investor sentiment. In the bond markets, the unchanged benchmark rate reinforces the attractiveness of fixed-income assets. While yields on government bonds may remain relatively stable, any surprises in future FOMC communications could lead to volatility. With higher interest rates, borrowing costs for consumers and businesses increase. This may lead to a moderation in consumer spending growth, affecting retail, housing, and auto sectors. The Fed's actions can also influence the US dollar's value. A more hawkish stance may lead to dollar appreciation, impacting exports and multinational corporations. Lastly, the Fed's commitment to monitoring inflation closely suggests that it aims to prevent sustained high inflation. Market participants will assess whether the central bank's actions align with its inflation targets. To sum up, the Federal Reserve's interest rate decision reflects its delicate balancing act between managing inflation and supporting economic recovery. As the markets digest the implications, investors and policymakers must remain vigilant for any shifts in the central bank's stance. Understanding the Fed's decisions and their impact on the economy is crucial for making informed decisions, whether you're an investor, business owner, or simply a consumer.